Good morning, everybody. Welcome to the Flow Show. Oh, look, I'm already mucking it up. Let me shut that up. There we go. I was about to say, back for a new week after the long holiday or long weekend here in the UK. Morning, Kay. How you doing, mate?
Good morning, Ryan. Good morning, viewers, listeners. Yeah, I'm good, man. I'm good.
Yeah, good weekend?
Yeah, it was pretty cool. No, nothing special really, but we at least had one dry day. The other one was a bit miserable.
Yeah, same here. That's our last bank holiday till Christmas, so that's your lot from now on in. US get one next Monday, so they get to have some fun of their own. Anyway, let's get cracking. China could cut their RRR in an effort to boost market liquidity, according to analysts speaking in the China Securities Journal. So perhaps a little bit of another nudge over whether we might get an RRR cut later this year or in the next couple of months. They are also, banks are supposedly weighing further deposit rate cuts to boost growth. So less to do with liquidity, more to do with growth on that measure there. So perhaps we should expect further easing over there in China. Coming across to Japan, and they are planning to expand their gasoline subsidies, as we spoke about last week. Those are coming to an end September, and gasoline prices have been at multi-year highs. So they're looking at potentially extending that to keep more fiscal measures going over there and helping with price rises. The government with an interesting observation saying that Japan is at an inflection point in its 25-year battle with deflation, saying that we shouldn't dismiss the fact that a window of opportunity may be opening to exit deflation. This comes as inflation perks up and public perceptions about persistent price declines abate, so it said. So again, the potential for another shift in long-term thinking from Japan coming in there. All this stuff can be data dependent. Kay, that's another step out of the mire, isn't it, for Japan?
Well, yeah, well, you have to acknowledge when you are running at over a year or a year and a half time, or 2 years now, above what they usually had as inflation, you have to change your papers a little bit. I mean, I found the title pretty spectacular. The first time in 50 years that they changed their lines, but all right. I mean, yeah, it's there. On the other hand, we heard from Ueda over the weekend in Jackson Hole, and he said that let's just continue doing stuff like we are now, and he doesn't seem in a hurry at all. To change things, and that's what ultimately I think will drive the end. We had an interesting discussion this morning in the chat room, actually, for those who are not there. That's one of the great things about the chat room, is that we don't only show charts, but we have discussions about what's going on and where the expectations of the one and the other are. And yeah, it's something that that's going to be. We need to keep an eye on, of course, what Ueda says, because he has, of course, the loudest voice in the Bank of Japan Governing Council, but then as well, against that article that we had from the Japanese government. And there was another guy, Watanabe, who was one of the candidates, actually, to replace Kuroda, says they should get rid of YCC once and for all. But then on the other hand, there's this article saying that the regulator is already monitoring the impact of normalization on the regional banks. So a bit similar. We can compare this situation a little bit to the local banks in the US. This one, because they are like long-term holders of JGBs, where the others have been shortening maturities, and they seem to if YCCs relax further or they start to raise interest rates de facto, then the regional banks could be in trouble. So and since the government and Ueda said that they will communicate and cooperate actually at the start of his tenure, I have the impression that we're still not out of the woods over there to normalize and loosen the strings further.
Yeah. How much fear do you think there is over there that even though the data's going the right way, you know, price pressures are there, how much fear is there holding them back from tightening to say, well, you know, is this really the time, rather than just another quick economic cycle of higher prices that's going to dissipate? How much do you think that might be holding them back?
I think very much so. The problem with Japan is that they have been on low growth for such a long time, and then at the same time fighting deflation. It's very hard to break loose from that straitjacket, and they have been like, and okay, they weren't spared from many disasters either, if you remember 2011, but it's been such a long fight, and that has driven a lot of the Japanese, the regional banks, but also the companies, into a certain straitjacket where it's really hard to break loose from it. I think the fear of overdoing stuff over there is pretty big. They don't want to kill their economy, but on the other side, but I mean, we could talk hours about this. Then if you look at the long term of things, perhaps that fear is even bigger because of the demographics and the local economy being at risk. The external economy is fine. The big four car makers, the heavy machinery, as we've seen numbers of late as well, that's fine. The internal economy is a different issue, and they will have to handle both sides of the coin, and that's where I think that they are very mindful. We also cannot forget, of course, the highly indebted government. So it's much less straightforward in Japan than it may be in any of the other big economies such as Europe, the US. China is a different issue, but yeah, I think they are very much afraid of starting to normalize and sending their economy down the drain.
Yeah, very much so. Right, so
sorry. The thing is, in Japan, you can hardly call it a robust. If you look at the difference between Japan and let's say the US and the EU. EU, we know, is a slow mover, and they can run on zero slow growth, but then they will go back to probably growth around 1.5–2% at one stage. The US economy is much more dynamic. You can have growth like is it the Atlanta Fed now cast or something that expects a third quarter growth at close to 6% in the United States, but then in Q4 you can see minus 1.5 or 2%. It's a much more dynamic economy still in the US than anywhere else. And Japan is like virtually on the opposite side. They've been struggling with their economy to get it back up. So the fear over there will indeed, as you say, be a lot bigger than anywhere else to do wrong.
Yeah, agreed with that. Well, some data that isn't quite going their way was the unemployment rate for July ticked up 2 pips to 2.7% from 2.5 estimated and previous. So a little bit of data there for Japan not going the right way, but we have seen that quite a bit of it is as well. Goldies thinks that the yen will retreat to levels seen in 1990, according to their grand seaweed claims, whatever tea leaves they're looking at. So just to give you an idea, that's where we were in the 90s, depending on what part of the 90s. we were all the way up in the 200s, and we had a little move all the way down to near where we were or where we are right now. So I'm not sure whereabouts in the 90s they're parking their bus for that one, but they've got a nice wide quote to play with there, somewhere between here and 250. Yeah, so a bit of a wide one for those guys there. RBA's Bullock says that the RBA may have to hike again. He's watching the data. Inflation is still too high in Australia, and that all central banks are grappling with how much further to hike. Riksbank's Floden, head of the Swedish central bank, says inflation is heading in the right direction, but there is still a long way to go, and monetary policy will probably need to remain tight for a fairly long period to come. After the summer, it looks as though the economic outlook instead needs to be revised down. The Swedish crown is undervalued by 20%. But there is no discussion about rate cuts in the near term at the Riksbank. Our view is that currency intervention is not a very effective method to affect the level of a currency. So a little bit, I wouldn't call it discord, but Riksbank's Bungie said that prices are still rising much too fast. So Floden saying inflation's heading in the right direction. Bunge is saying that prices are still rising much too fast, and it looks now like the fight against inflation is not over yet. So maybe a little bit of a disagreement there at the Riksbank. So are you making anything of their comments at the moment, Kay, and are they powerless to do anything right now?
The thing in Sweden is I haven't traded it much. I'm looking at the Swedish krona from a distance. It's still very much it's still very weak, let's call it that way. Yeah, it shied off the highs when you look at that Euro Stocky. It's you're on the dollar. Okay. Yeah, that Euro Stocky just is shy of the highs, about 1% below the highs. But Sweden has an issue. They really need better data to come out. In the meantime, and it's also a struggle for the central bank. It's been a struggle over there for the central bank for quite a while. Let's face it. It's been they as you say, they can't agree on much stuff, because we've seen Floden, but then the other guys talking in a different way. Some are interventionists. The other ones are, I can't do anything about it. It's still a difficult situation. I think for us traders, for me at least, it's not easy. If you look at where we are now, this does not testify of a market that has confidence in the Swedish krona, right? Yeah. Because we often call it an accelerated euro, because the eurozone is the biggest trading partner of Sweden. But that's been more than just an accelerated euro lately. It's just been weakening. So yeah, I think I'll leave it right now. I know that the Riksbank has a difficult task. If they go onto the intervention route, we have to know that the Riksbank is not even close to being anywhere as big as the main European central banks and let alone the F.A.C.E and everything. So they will have a tough time. It's I'm not saying we are in no way close to Turkish or so situation, because the economy is doing better than over there. But like liquidity wise, it could be a very hard call if they decide to intervene, and then they will have to get some form of help, I think, from instances like the European Central Bank, and at least have the agreement as well from the ECB. So it's a very, very difficult call over there, which I'm actually not really ready to make. I only see that the Swedish krona is not doing very well.
Yeah, because there's two things to consider. One, if they do
need the
intervene,
geopolitics to calm down a little bit, because they are some of their borders are very close to Russia, right?
Yeah, well, that was what I was going to ask as well. But one of the factors is that obviously if they do intervene, they'll be buying their own currency, which puts them on the wrong side, because if you want to intervene, you want to be selling your own currency, because then you can print your own currency, you don't run out of it. If you're buying your own currency, you're using up whatever reserves, FX reserves you've built, you're limited to those. But yeah, I mean, they seem to be in a bit of a hope situation, which is never a good position to be in, where they're hoping that other factors might cause their currency to strengthen rather than their own, and that's not a good theme to be in. But like you say, yeah, they are close proximity to the war, and with everything going on with NATO, that could impact them further. But it's going to take other forces outside of Sweden to get this turning around, unless they suddenly turn into the hottest economy on the planet, which I suggest isn't going to be anytime soon.
Yeah. Psychologically, they could get a boost from when I don't know when that's to happen. When they join NATO, that's maybe a psychological boost that they will get over there. But
yeah, won't change likely change the underlying dynamics though. So might be a decent fade, that one, if it does happen. Anyway, moving on to good old ECB, and Hawke Holtzman sees a case for a rate hike if no surprises turn up ahead of the September meeting. They're not in the clear on inflation, and labour markets are very tight. Thinks that the ECB is still behind the curve, and that we can assess policy once it's at 4%. And the ECB should also start a debate on ending PEPP reinvestments. ECB's Nagel says we will remain data dependent until September and will give no signals today. That was yesterday. The German economic situation is challenging. I think that's being very polite for that one. Finnish central banker Välimäki, if I'm saying that right, says the September decision is data dependent. Took over from Olli Rehn at the Finnish Central Bank. Spain retail sales, not been a lot of data out, but Spanish retail sales came in year on year 7.3%. versus 6.7 expected and 6.4 prior. So decent numbers there from Spain year on year, seasonally adjusted. As you can see there, I'm not sure what that 0.6% is, as these are year on year numbers. So that's a bit of an error on that front. But as you can see, decent retail sales there. Over in China, well, geopolitics really between the US and China. They plan to hold at least annual meetings on export control information exchanges, according to a senior US official. China's Wang and Raimondo agreed to meet at least once a year, so maybe some thawing of tensions there. One to keep an eye on for you folks in the US, or if you're watching US trading, particularly oil and things like that, is that Hurricane Idalia, I don't even know how to pronounce this, Idalia, is now been confirmed as a hurricane and expected to intensify into an extremely dangerous major hurricane before landfall on Wednesday. So it's into the Florida area, which will potentially or likely impact oil production and refinery things over there. So if you are trading oil, keep an eye on that. But first and foremost, we hope everyone stays safe over there while that hits land. That's all I've really got on the headline front. I was going to report on the weekend stuff with Jackson's Hole, but it was a bit of a damp squib in the end. Not too much going on. Anything you picked out of that?
No, well, just we've already spoken about it on yesterday's F.A.C.E. I think it's Lagarde didn't give the doves much, but then she spoke twice, once in the hole and then once to Bloomberg, a bit of a lawyer's talk, speaking for 20-30 minutes just to say that they are data dependent. And Powell did roughly the same, right? They're data dependent. The funny thing is that people read both sides of it in the press. I think it's been very neutral. And then, as I said earlier today, the UVIDA was actually relatively dovish, if you ask me. I mean, not at least not giving anything to the yen bulls. And then you get back to where the differentials are and stuff, and then you have to note that the 10-year JGBs is at 65 BPs and the 10-year US is at 420%, and that's basically it, right now. No, there's been a lot of yada yada in China again. Evergrande reopened after, what is it, a few months now of being closed, lost 87% of its value, but that's not a surprise. We knew that. No, I haven't seen anything world shocking out in between the last flow show we did on Friday and today. Really, we're end of month, Ryan, and that's going, I reckon, to dominate the flows in the immediate, and then we are going to have a pretty decent flurry of data coming up, right? For the rest of the week, and that's going to now we can turn our attention to that. I think the rest we've had it,
Yeah. And I wanted to highlight what data we do have this week. Starts today, we get some house price data from Case-Shiller from the US and F.A.C.E, and then we get the big conference board consumer confidence number in the US. So we'll keep an eye on that to see what's happening with that, and also the inflation expectations within that. Jolts are out as well, which are always lagging by a month, but we'll see if we continue to see the ratio reducing between job openings and unemployment. Have been moving sub 10 million and continuing to fall, so that gives us an indication on whether the market is tightening up further. Coming over to Wednesday, Eurozone economic sentiment, which contains the consumer confidence flash that we got last week. Again, looking at the price components, selling prices and consumer inflation expectations there. It's also regional CPI day from Germany, which ends with the whole German number at 1 p.m. Tomorrow. Then obviously ADP coming in there, final GDP numbers from the US, so that probably won't be much to worry about there unless there is another big variation in that, but the ADP will give us our first look at the jobs situation. A bit of Japanese data, retail sales, industrial production on Thursday, and then retail sales from a few other countries, Germany, Swiss, and the likes there. Bit of PPI, CPI data out of France, and flash numbers, as you can see, from the Eurozone, so further new CPI or inflationary data. We're going to be getting again ahead of the next round of central bank meetings coming up. ECB minutes again. Well, these might hold a bit of something we haven't heard, because central bankers from the ECB have been few and far between, as most of them on their holidays. So we might get something in there we haven't heard before, though I think that risk is small. Challenger layoffs gives us a little bit of a look into how firms are faring. Are we seeing some big layoffs coming in? We saw that happening in the tech sector, then things calmed down a little bit. So again, more clues for jobs. Obviously, we'll keep an eye on the US jobless claims as well. PCE data, I think that is coming out on the income and outlays, if I'm not mistaken. Let's have a quick look, see if it says it in there. Yep, so that's the PCE data for the month coming in on Thursday. Usually it's on a Friday. I'm not sure why it's on a Thursday, but I'm not going to complain. Obviously, Friday is going to be mainly seen for the US jobs picture, though we get the final numbers, PMI manufacturing numbers from Eurozone countries, as well as some fresh ones from the likes of Italy and Spain. Then we got jobs, as I say, And again, a little bit of a strange one, because usually when the jobs number drops on the 1st of a month and it's a Friday, it's kicked to the next week. So we've got a little bit of a bonus there. Maybe the holiday next week's caused that, but very rare to find it on the actual 1st of the month. We don't have double bubble Canadian jobs, so it's all going to be about the US and that. But then we get the big ISM numbers dropping through and start with manufacturing on Friday. So that'll give us some secondary data after the NFP. So it could be a bit of a wild Friday before the US go into a long weekend. Anything in that lot, Kay, tickling your fancy aside from the jobs?
A preview that I've seen, I think is JP Morgan, saying that they expect a weaker NFP coming in because of all those layoffs that we've seen in some of the sectors. So look at the private number in that one. I think maybe interesting, because they're expecting 125K instead of 160, somewhere 160 expected, I think, right now. So that it may be, it just may be that finally we are going to get a number that undershoots, and we are seeing something change in the unemployment rate or so. All right, so it's something to look at. I think it's a bit of a, it could, I'm not saying wild, but it could get a bit volatile, right? Because we do have the end of the month, and we do have data starting to roll in. So that's going to make it interesting. And then next week we start September in full force, and with the big boys coming back to the office. So we may be just preparing some decent moves for the end of the week or next week, right?
Yeah, we're very much getting to the end of summer now, and summer trading. Speaking to Michael Brown at Pepperstone this morning, and he says he got on his train and much busier than normal. So I think we've got the last few days this week of the summer stuff, and then next week we're back full on. But this data all through the week is going to matter. We know prices can swing around, so it's not going to be a case of trying to take a side. I think for all this data later on, you've got to see what happens every day with the data and where we sit going into the next data point. But should be interesting. Non-farms are expected around the 170K mark at the moment.
Okay.
And any revisions to that. Yes, mate?
Yeah, I said, okay, I thought it was like 160 or so. No, it's fine.
Yeah, that's cool. The only thing I would say about the NFP is it has been now starting to trend below 200,000. We had those really high prints a few months ago, but then the last few prints have been sub 200. So maybe we're seeing a little bit of a trend, but we've got a week to get stuck into the NFP stuff anyway. Right, just taking a look at a couple of pairs coming back for the weekend. Just a case of seeing where we're sitting with quite a few pairs. Dollar yen, this one's still messing around with this 146.50 area. I think you've got to look for a potential move above and finally seeing it hold above probably 146.60. If you start to see it holding above 146.60, then we might be on for a bit of a further move up. But it's doing a bit of head bumping at the moment, a little bit of an extension on yesterday, thinner markets, but still hanging about this level. Quite clearly see where the main support is. It's still down into 145s and that extension just below there. If we do manage a move up, then we're talking the 137s for the next levels for that one. But so far, at least over the last couple of weeks, no real change to the picture there. A lot of levels seem to be holding around the grounds. Aussie dollar still holding above full 64. I've had a couple of probes below, a couple of times we've sat below there, but we can't seem to keep it below there for any length of time. So maybe I always talk about what the sort of price action you want to look for when you're looking to find a bottom in pairs, and your first step is when it stops going down. Well, this now looks like it might have stopped going down for now, but then you've got to watch the bounces. Same for the Kiwi, which I'm still long a bit of. This one looks slightly different because we have been still making lower lows and busting under that 59. But again, like the 64 in the Aussie dollar, we can't hold below that. Currently have held the trend line on recent tests, but the bounces look very weak from this one. So I'm looking to get out a bit more of my longs if we get a moves up above where we're currently at. I'm going to keep my sell stops in play because, as I say, this one still looks a bit weaker, but it stopped significantly falling. Let's call it that. So there's still in the balance as to whether we can bounce on this one. We're going to need to move back above this 59.90 and the 60 big figure to take a lot of the pressure off. If we can't do that, it keeps the downside in play. Euro sterling as well. After that, another bounce off the 85 last week, got up to near 86s, banged ahead, come off a little bit. So I still don't think we're out the woods on this one, but it's looking a bit stronger now. This really has been a perfect example of how to play what's coming up with rate cut trade, seeing how data moves markets. You remember this break came on the German PMIs, the services collapsing last week. Then we got the bounce on the UK services collapsing. So as you can see, we've held that. So at the moment, obviously the pound, the UK is the smaller economy, but it's showing why the euro might be the strongest one in the book compared to that. So this is, as I say, this is what we're going to be looking at over the next few months, particularly into the end of the year, early next year, which economies are going to suffer the most, and thus you're going to see those currencies suffering the most on that one too. Dollar China had a couple of cracks below 728, but still can't hold a break under. Now we've got a bit of a level around about 726.80, call it 727. Always got to give it a couple of big figures on this one. It's still not letting these highs out the woods yet, so there's every chance we can make a move higher. Anything in particular going on in this one at the moment, Kay?
Yeah, just China again expected to cut mortgage rates this time, being out like a few minutes ago, but it's like a lot of expectations of more injections, and then it's like, I don't know. I mean, the government, the central bank is injecting, sorry, loads and loads of money in the market, and then at the same time trying to keep a lead on the dollar China. I haven't changed my opinion. I still think they are in trouble over there for now. But if PBOC manages to keep a lead on the dollar China for, let's say, into the first half of September, things may change a little bit. It's, you know, they're just keeping it in check. Again, as I'm saying, I think we have to be mindful of that 2% dollar CNY band around the fixing to know how far they are going to let the CNH go as well. I think they are trying to manage the one by fixing the other, you know, and that's what's going on. Let the market do its thing. I think we would be trading higher, quite a bit higher, but yeah, because I don't recall exactly which company, but they are trying to sell off their Chinese entity as well. I think that was yesterday or over the weekend. So people are still getting out of China. But we're trading 730. We are not trading 725, 720, or we're not trading 737, 738. We are hanging around here. So for the time being, there's a bit of if you trade it, there's a bit for both. If you're an investor, you're still worried, right?
Yeah, exactly. Yeah, and we're fortunate enough we can move pretty quickly with our trades and our positioning and our bias. So yeah, no need to get caught too far one way or the other. As I say, either we're going to get under 728 and hold it, that should give us a shove down, or we're going to get back to the highs and maybe crack them. So potentially setting up a bit of a range play and a potential break play as well on that one. Just a couple of others. Keep an eye on stocks. Still a bit neutral for me. I mean, we're a bit all over the place. You know, last week we had that really strong bounce from the 43.30s, all the way up to the 50 fib, and then a complete reversal after that, all the way back down again, and then we held down in the 43.5s. Then we've had a bounce back up to the 44.5s. This still smacks of a market that is a bit unsure of what it wants to do, trading between the goalposts. So you've got to be a bit cautious with this one at the moment. The trend might be broken, it might not be broken. Certainly there's a bit more volatility in the middle here. I think that's going to pick up, particularly this week and all the data we're going to get. So you need to be picking your levels in this one. You know, anything that sends us back up to 45s, you need to keep a close eye on, because that's the big area there. If we bust that, then maybe we're going to be pushing up towards the highs in the 46s again. But on the other side, if we can't get above this zone again and hold it, then that keeps the downside in play. And as you can see, we have not been too slow in making those downside moves when it's felt justified. So pick your spots for this one if you're trading stocks, because it's looking a bit messy in the middle here. Okay, did you want to run over a couple?
Yeah. Although I must say, yeah, sure, mate. But I must say, first of all, I want to say I'm in month-end mode, because I think what's waiting for us is probably important enough to give us a hint what people will want to do with, call it yields, call it differentials, bond market, and perhaps as per correlation with equity market. So for the time being, we are trading value date month end. We've got probably we've got those yields and consumer confidence coming out today, but I think tomorrow we will start to really have a look on what we could possibly do in September. It could get a little volatile into the month end, but we are August. It's usually not one of those big months. It's not an end of quarter, end of semi-year. People are still coming back from holidays, so I wouldn't. I'm not expecting huge volumes, but I'm expecting a bit of lack of liquidity, perhaps, because we are in the expectation of pretty important data going into September. So on the differential front, we've seen the EU 2-year with the US 2-year coming back from a pretty low level, and we're back relatively to the prior, wouldn't call it really break zone, but the levels that we should keep an eye on, 190 BPs differentials. And you see it in the euro dollar. Yeah, we printed that 107.67 in the last week, and we are back above 108. The rest is really month end. I actually don't really want to take a side on this euro dollar. We are still trying to keep in that wedge. We are still above those two trend lines here. As I said, I think if this would lose 107.25, that means that something will have given us this direction in the upcoming days. I don't know whether we are going to trade there or not, or a bit higher on the month end. But I think for the new month, this is going to be your level to watch. Yeah, cable, as you said, it's trying to make up its mind. It's still hovering around this downside trend line. I think and we've revisited it this morning, I think on a pretty quick stop run. This 126, 15, 30, 35, yeah, that's your area where when the dust settles, are we going to be above, which would be causing a failed breakdown, or are we going to trade below to start the new month? And that will be much more important, because then we can have a look at those low 124s. Again, month end, don't take anything for a new trend or really okay, this is what's going to happen in September, right? It's end of month, and you have to know what the flows are rather for month end. I've seen a few flows coming in saying that it should be rather dollar buying, which is logic with a lower S&P, but then the S&P is trying to recover. So is it going to compensate? We may have like very little flows actually going into the end of month. But to start, and especially probably on Friday on the NFPs, this may be your decision area, whether we start to creep back up or start to go down to 124s on the cable. That is one. Dollar yen, yeah, Ryan already showed it, but we were talking about this in the room. Not only dollar yen, but you need to now watch the dollar yen, and we have been talking about this for a while now in the room, probably more as an index than really only dollar yen. If it would only depend on dollar yen, with what Ueda has said, I think dollar yen is going to trade higher, because Ueda is not doing anything to bring down interest rate differentials between the yen and anywhere else. But if you look at it as an index, and if you look at stuff like, for instance, Aussie yen, who has been respecting this downside trend line, is now starting to break up again. So that's going to be supportive also for dollar yen. If you look at stuff like Kiwi yen, that's been holding a support and starting to at least stabilize, but not saying that we return towards the highs, but it's holding. If you look at Euro yen, that is still supportive around this this trend line lately. So there are signs that the yen is starting to weaken again. It is holding here. I think it's likely with Ueda going to move a bit higher again. But it's not only the dollar yen, right? So we were talking about possible interventions, and the thing is that you may have to look at some sort of an index, whether it's the trade weighted index, whether it is the NIR, whether it is some other index of strength, and you have to look at where this is. If the yen weakens on its own, that may already be enough to trigger some comments by the MOF. Not saying it will, just need to keep an eye on it and see. If you look at a stable dollar yen, and yet they still they still come out with comments, that's perhaps a very good indication that they are not only looking at dollar yen. Okay, if it's only depending on the dollar yen, with what Ueda said, I think it's only a matter of time for this to start to trade higher again. But then again, as I'm always saying, I mean, look at the other side of currency pairs. If we start to get bad numbers out of the US, then it could very much start to look as a failed breakup here at some stage. So for the time being, I think it's going to remain supported, and then we see what happens. If we start to get back below 146, the figure for a starter, then it's much more neutral, right? And then we talk again about the 145. But until then, we are trading rather end of month. Really, I don't need to show a lot of other stuff. Euromex still very much on the defensive. We need to get back above 18.25.30 to start to correct or to get more into a neutral scenario. I've covered a bit more of my shorts just because it's end of month, and I don't want to have to worry about too many things if we would see a little bit of a correction or so. I want to see what the US data bring, because they will influence the Mexican peso as well. And then dollar China, Ryan already showed it, and this is probably your visual of the 727, 728, 726s, this trend line. For as long as it holds, I think nothing changes, but then PBOC is really keeping a close eye on the debates. Okay, and that's it for me for today. Ryan, back to you.
Thank you very much, mate. Well, that's got us set up for our shortened week, almost like a shortened week. So hopefully you guys and girls are going to make plenty of pips this week. Can continue to follow us on the show here as well. Thank you very much for your participation. Thank you very much to Kay for his input as well. Have a great day. Have a great week. And we shall see you all bright and breezy tomorrow.
Good day.